Hello everyone, welcome to EPK Capital's 15th August Daily Brief video. I am your host Shilpa. In this series, we analyze and scrutinize everything that has happened in the world of finance that impacts your investment. Just a quick note that this video is for educational purpose only, and should not be taken as a financial advice. For your personal advice, you can connect with us or your personal financial advisor. Today's session was defined by a complex and often contradictory set of signals, creating a global tug-of-war between a surprisingly resilient American consumer and gathering economic clouds on the horizon. On one side, robust U.S. retail sales data provided a powerful pillar of support for the world's largest economy. On the other, a torrent of concerning data, from a significant economic slowdown in China to stubbornly hot wholesale inflation in the United States, cast long shadows over the global growth outlook. This dynamic led to a cautious, mixed, and highly divergent trading session across global markets. Wall Street struggled for direction, with a notable split between the performance of large-cap behemoths and their smaller, more economically sensitive peers. In Asia, markets rallied on geopolitical relief, even as the region's primary economic engine showed clear signs of sputtering. Meanwhile, in India, a major policy speech from Prime Minister Narendra Modi outlined an ambitious vision for economic self-reliance that could have long-term implications for global supply chains. In this report, we will dissect these key themes, starting with a snapshot of the closing bell across the globe. We will then take a deep dive into the crucial macroeconomic data that shape the day's narrative, analyze the intersection of politics and portfolios, and provide an update from the digital frontier of cryptocurrency markets before concluding with a look at the corporate movers and shakers that define the session. The day's trading activity painted a picture of uncertainty and divergence, with no single narrative dominating across all regions. While headline indices in the U.S. appeared calm, underlying metrics revealed a market grappling with conflicting economic signals. Wall Street ended the day with a lack of clear conviction, closing a volatile week on a mixed and mostly flat note. The broad S&P 500 index managed to eke out a fractional gain, rising 0.03% to close at 6,468.54.1. The Dow Jones Industrial Average slipped by a marginal 0.02% or 11 points to finish at 44,911.26.1. The technology-centric Nasdaq Composite finished nearly unchanged, down just 0.01% at 21,710.67.1. However, this flat performance at the index level masked a significant underlying trend of risk aversion. While mega-cap technology and industrial stocks held firm, with the NYSE FANG Plus Index down only 0.10% for, smaller, more economically sensitive companies faced heavy selling pressure. The Russell 2000 Index, a key barometer for small-cap stocks, fell sharply by 1.24%. This divergence was underscored by a notable jump in the CBO Volatility Index, VX, the market's fear gauge, which rose 2.35% to 14.83, signaling an increase in investor anxiety. The day's trading action pointed to a flight to quality within the equity market itself. As investors digested contradictory U.S. economic data, strong consumer spending on one hand and hot producer inflation on the other, a clear pattern of risk reduction emerged. Small-cap companies, which are generally more reliant on a robust domestic economy and more vulnerable to the effects of higher interest rates, were sold off decisively. Yet, investors did not pull out of the stock market entirely. Instead, capital appeared to rotate into the perceived safety of large-cap and mega-cap technology stocks, which possess more diversified global revenue streams and stronger balance sheets, making them better equipped to weather a potential economic downturn. This explains why the S&P 500 and Nasdaq held up while the Russell 2000 and equal-weighted versions of the S&P 500 underperformed significantly. European bourses closed higher, largely concluding their trading day before the full weight of the US data could be digested. In London, the FTSE 100 gained 0.13% to close at 9,177.24.6. Frankfurt's DAX index had a stronger session, rising 0.79% to finish the day at 24,377.50.6. The positive sentiment in Europe followed a week where flash estimates for July Eurozone inflation were confirmed to be stable at the European Central Bank's 2.0% target, presenting a less complicated monetary policy picture compared to the conflicting signals emanating from the United States. Asian markets posted strong gains earlier in the day, with sentiment driven primarily by relief over the Trump administration's confirmation of an extended truce in the trade war with China. Japan's Nikkei 225 surged 1.3% to close at 43,274.67.9. In Hong Kong, the Hang Seng Index jumped an impressive 2.5% to 25,596.90. While the Shanghai Composite added 0.5% to finish at 3,683.46.9. This powerful rally, however, appeared completely disconnected from the fundamental economic data released from China during the session, which was unequivocally weak. The market's positive reaction was based on the absence of a new negative, the escalation of tariffs, while largely ignoring the presence of a worsening existing negative, a significant domestic economic slowdown. This disconnect suggests the rally was built on a fragile, news-driven foundation. Once the initial relief from the tariff news fades, global markets will be forced to confront the reality of China's sputtering economy, which has profound implications for global growth projections. Today was a pivotal day for economic data releases, providing a complex and at times contradictory assessment of the global economy's health. The reports from the US and China were particularly influential, shaping the cautious tone that prevailed in Western markets. The main story out of the US was the remarkable resilience of the consumer. The July retail sales report, released at 8:30 a.m. ET, showed that headline sales rose by 0.6% month over month, matching June's strong pace and beating the consensus forecast, which had centered around 0.4% to 0.5%. On a year-over-year basis, sales were up a healthy 3.9%. This data indicates that despite persistent inflation and elevated interest rates, consumer spending remains a powerful engine for the U.S. economy. However, this strength in spending was not matched by consumer confidence. The preliminary reading for the August University of Michigan Consumer Sentiment Index came in at 61.7, slightly missing the forecast of 61.9 and remaining essentially flat from July's final reading. While sentiment has improved from its lows, it remains at historically subdued levels, with consumers expressing ongoing concerns about the economic trajectory. Critically, the report's details on inflation expectations will be closely watched in the final release, as the July report had shown a welcome decline in both 1-year and 5-year expectations. In stark contrast to the robust consumption figures, the production side of the U.S. economy appears to be stalling. The July industrial production report, released at 9:15 a.m. ET, was forecast to show a 0.0% month-over-month change, indicating a pause in industrial output after a modest 0.3% gain in June. This stagnation highlights a growing divergence within the U.S. economy. Further reinforcing this cautious outlook from the business side, the report on June business inventories, released at 10 a.m. ET, showed a modest increase of just 0.1%. This followed 2 consecutive months of flat 0.0% readings, suggesting businesses are hesitant to build up stock in an uncertain economic environment. This presents an unsustainable divergence. The U.S. economy is currently running on 2 different tracks: a fast-moving consumer track fueled by strong spending, and a stalled industrial track characterized by flat production. This gap can only be sustained in the short term by drawing down existing inventories. If strong consumer demand continues, production must eventually ramp up to meet it. However, attempting to increase output in the current environment, with ongoing supply chain issues and high input costs, as evidenced by yesterday's hot producer price data, will inevitably lead to higher prices. This creates a direct causal link between the production-consumption gap and the risk of future inflation. Data released overnight from China's National Bureau of Statistics painted a worrying picture of the world's second-largest economy losing significant momentum. The figures for July were weak across the board. Industrial production grew by 5.7% year-on-year, a marked slowdown from 6.8% in June and below analyst expectations. Retail sales rose by only 3.7%, a sharp deceleration from 4.8% in the prior month and a significant miss on forecasts. Fixed asset investment increased by a meager 1.6% in the first 7 months of the year, pointing to a severe lack of business confidence. These figures confirm that the key drivers of China's economy are weakening simultaneously. The prolonged slump in the property market continues to crush consumer confidence and household wealth, crimping spending. At the same time, both domestic and external demand for manufactured goods is softening. This worrying loss of momentum has prompted widespread calls for more significant policy stimulus from Beijing to avert a sharper downturn that would have significant ripple effects across the global economy. The week's inflation data has created a complex and confusing picture for central bankers and investors. In the U.S., the Consumer Price Index, CPI, for July, released on August 12th, was relatively benign, with the headline annual rate holding steady at 2.7%. This initially fueled hopes for a Federal Reserve rate cut. Those hopes were dashed on August 14th by a shockingly hot Producer Price Index, PPI report. Wholesale prices jumped 0.9% month over month, far exceeding the 0.2% forecast. Annually, the PPI hit 3.3%, its highest level in 5 months. This data suggests that cost pressures, potentially exacerbated by tariffs, are building in the production pipeline and could soon translate into higher consumer prices. This conflicting data from the U.S. contrasts sharply with the situation in other major economies. The Eurozone saw its July inflation rate hold steady at the ECB's 2.0% target. Meanwhile, India recently reported that its July retail inflation fell to an 8-year low of 1.55%, well below its central bank's tolerance band. This leaves the U.S. Federal Reserve in a particularly difficult position. A weakening labor market and moderating consumer price inflation argue for an interest rate cut to support the economy. However, a scorching hot PPI report, which often leads the CPI, suggests that inflation is reaccelerating and that the Fed should maintain its restrictive stance. The market is now caught between these two possibilities, and this policy uncertainty was the primary driver of the day's volatility and the risk-off rotation in U.S. markets. Prime Minister Modi's vision for a self-reliant India. In his 79th Independence Day address from the ramparts of the Red Fort, Indian Prime Minister Narendra Modi laid out a powerful economic vision centered on the theme of Atmanirbhar Bharat, or a self-reliant India. The speech included several major announcements with direct market implications. Semiconductor mission. The Prime Minister made a bold promise that made in India semiconductor chips, produced by Indian talent in Indian facilities, will be available in the market by the end of 2025. This initiative is backed by significant government investment under the India Semiconductor Mission, which has already sanctioned 10 projects worth nearly 1.60 lakh crore rupees across 6 states. GST reforms. A pledge was made to introduce next-generation GST reforms by the festival of Diwali. These reforms are aimed at reducing the tax burden on common-use items and providing relief to micro, small, and medium enterprises, MSMEs. Defense self-reliance. Modi called for the domestic production of jet engines for India's fighter aircraft and announced plans to develop a Sudarshan Chakra national defense shield to protect critical infrastructure. This speech signals a clear and long-term structural shift in India's economic strategy. The intense focus on semiconductors and advanced defense manufacturing is a direct attempt to position India as a viable China plus one alternative in global high-tech supply chains. This creates a multi-year tailwind for investment in India's domestic manufacturing, technology, and defense sectors. The promise of GST reform is a more immediate potential catalyst. By boosting disposable income and easing the burden on small businesses, it could provide a significant lift to domestic consumption, making India's growth story even more compelling, especially given its currently benign inflation environment. While there was no major speech from the U.S. president, the influence of his administration's policies was a key undercurrent in the market. The direct impact of trade policy on corporate earnings was on full display. Shares of Tapestry, TPR, the parent company of luxury brands like Coach and Kate Spade, plunged nearly 16% after the company explicitly warned that tariffs could negatively impact its fiscal 2026 profit outlook by as much as $160 million. In a more unconventional development, reports emerged that the Trump administration is in discussions to take a government stake in the struggling chip maker Intel, INTC. This news sent Intel's shares surging 7.4%, making it the day's top performer in the S&P 500. This type of direct government intervention in a specific company is highly unusual for the United States and adds another layer of political risk to the market. Some analysts have noted that such actions are more characteristic of emerging market economies, introducing a new and unpredictable variable for investors to consider. After a volatile week that saw the crypto market reach new all-time highs, Friday was a day of consolidation and significant corporate maneuvering. Bitcoin and Ethereum cool off after record highs. The major cryptocurrencies pulled back from their recent peaks as the market paused to digest massive gains. Bitcoin, BTC, was trading around $118,900 in late afternoon trading, down from its record high of $124,174 set on Thursday. Ethereum, ETH, was trading around $4,624, retreating from its multi-year peak of $4,188 reached a day earlier. Technical analysis suggests that Bitcoin is finding a level of support around the $116,000 mark, while Ethereum is holding above key support at $4,488, indicating that the pullback has so far been orderly. Crypto corporate landscape shifts. In what is being seen as a landmark deal for the industry, crypto exchange Coinbase, Coin, officially closed its acquisition of Deribit, one of the world's leading crypto derivatives platforms. This acquisition is more than just a standard business transaction. It signals a significant step in the maturation of the cryptocurrency asset class. Derivatives, such as options and futures, are sophisticated financial instruments essential for risk management and price discovery in mature markets. By acquiring a dominant derivatives player like Deribit, which saw over $185 billion in trading volume in July alone, Coinbase is building the critical infrastructure necessary to serve large institutional investors. This move helps to consolidate the market and furthers the evolution of crypto from a purely retail-driven speculative asset toward a more established component of the global financial system. Corporate Pulse: movers, shakers, and deal makers. Beyond the broad market trends, a number of company-specific stories drove significant stock movements and highlighted key themes in the corporate world. Key stock movements. Berkshire Hathaway's moves. Warren Buffett's investment vehicle, Berkshire Hathaway, revealed in a regulatory filing that it had further trimmed its massive stake in Apple, AAPL, during the second quarter. Simultaneously, it initiated a new, large position in healthcare giant UnitedHealth, UNH. These moves provide a window into where one of the world's most influential investors sees value and risk in the current market. Intel's surge. As previously mentioned, Intel, INTC, was the top performer in the S&P 500, jumping 7.4% on the back of reports that the U.S. government was considering taking a stake in the company. Tapestry's tumble. The luxury goods firm. Tapestry, TPR, was the day's worst performer in the S&P 500, falling nearly 16% after its profit outlook was slashed due to the anticipated negative impact of tariffs. Deere's decline. Farm and construction equipment maker Deere, DE, saw its shares fall after the company cut its full-year outlook, citing weaker volumes and increasingly cautious customer sentiment amid economic uncertainty. Merger and acquisition highlights. Despite the macroeconomic uncertainty, corporate deal-making continued at a brisk pace, indicating that companies with strong balance sheets remain confident in pursuing strategic growth. In European banking, UniCredit Bank and Alpha Bank Romania finalized their merger today, a move that will create a more significant and competitive financial institution in the region. In the technology sector, in addition to the major Coinbase Deribit deal, consulting giant Accenture announced its agreement to acquire CyberCX, a leading cybersecurity services provider, to expand its capabilities in the Asia-Pacific region. Conclusion: navigating the crossroads of uncertainty. Today, August 15, 2025, was a day defined by a tug-of-war between competing economic narratives. The clear resilience of the U.S. consumer provided a bullish counterpoint to the decidedly bearish signals emanating from rising producer inflation, a sputtering Chinese economy, and a stagnant U.S. industrial sector. This conflict left major U.S. indices treading water, but triggered a clear rotation away from riskier assets under the surface. The market now stands at a critical crossroads. The key question for the week ahead is which of these narratives will ultimately prevail. Will the strength of consumer spending be enough to pull the broader economy forward? Or will the combined weight of inflation, slowing global growth, and policy uncertainty finally trigger a more significant downturn? Investors will be keenly watching for any commentary from Federal Reserve officials for clues on how they are interpreting this conflicting data, as the path of monetary policy remains the single most important driver for markets. The reopening of Indian markets on Monday will also be a key focus. As traders there will have their first opportunity to react to Prime Minister Modi's ambitious and potentially transformative economic agenda. We hope you found this video informative. If you did, then please do like, share, and subscribe to our channel for such amazing content daily. For more information or for your personal financial advice, kindly connect with us on the details given in description. Thanks for watching.